U.S. trade deficit hits two-year low. Trump's tariffs impact economy. America's trade landscape is undergoing a seismic shift, and the latest numbers are proof. The U.S. trade deficit has dropped to its lowest level in over 2 years, and President Trump's aggressive tariffs are sending shockwaves well beyond mere trade statistics. This could mean significant changes for consumers, businesses, and even entire industries. But here's where things get truly controversial. Are these tariffs really helping the U.S. economy, or are they doing more harm than good? Let's break down the details. This June, the U.S. trade deficit shrank by a dramatic 16%, reaching just $60.2 billion, according to the Commerce Department's Bureau of Economic Analysis. After seeing a sharp plunge in goods imports, especially consumer products, the overall trade gap, including both goods and services, is now at its narrowest since late 2023. What's driving this sudden drop? Tariffs. Businesses and consumers rushed to buy ahead of tariff deadlines earlier in the year, leading to a recent slowdown in imports, particularly for consumer goods and industrial supplies. Exports of capital goods, on the other hand, surged to an all-time high, showcasing a complex economic balancing act. Still, these improvements in the trade deficit had a sizable impact on the nation's economic output. The narrower trade gap played a key role in a 3.0% annualized expansion of U.S. GDP last quarter. A stark turnaround from the previous 3 months, when the economy slumped. But here's the part most people overlook. While fewer imports and a smaller trade deficit look like wins on paper, underneath the surface, the broader economy, especially the sprawling services sector, is starting to show signs of strain. Services make up about 2/3 of all U.S. economic activity, and their growth rate slowed to a near standstill in July. Businesses report that the steady rise in import taxes is not only raising their costs, but also making it much harder to plan for the future. One clear measurement, the Institute for Supply Management's Non-Manufacturing Index, drifted barely above neutral at 50.1, disappointing those who hoped for stronger growth. Let's dig into some specifics. Imports of consumer items and industrial materials have fallen to levels not seen since the height of the COVID-19 pandemic. At the same time, some categories, like capital goods, bucked the trend by hitting record highs for exports. Even so, many business leaders now feel cornered by persistent tariff-driven uncertainty. Perhaps the most dramatic shift has been in America's trading relationship with China. In June alone, the U.S. deficit with China shrank by about a third, dropping to just $9.5 billion, a low not seen since early 2004. Over the past 5 months, this gap has plummeted by 70%, suggesting a massive realignment in global commerce. Imports from China, squeezed by harsh 30% tariffs on most goods, have fallen to levels last witnessed in 2009. Are we witnessing a permanent change in global supply chains? Trump's White House recently notified dozens of trading partners that new tariffs, ranging from 10% to a staggering 41%, will soon take effect, with the average U.S. tariff rate leaping to 18.3%. This is the highest since the 1930s, an era associated with the Great Depression and a global trade collapse. Critics argue such high tariffs risk stifling growth and innovation, despite a temporary boost from reduced policy uncertainty. Oren Kleck, economist at Nationwide Financial Markets, warns that the harms of high tariffs may eventually outweigh their short-term benefits. Meanwhile, trade negotiations keep the headlines busy. U.S. and Chinese officials met recently in Sweden to discuss the continuing tariff tit-for-tat. The negotiators proposed extending the life of current tariffs rather than letting them snap back to rates exceeding 100%, a move that only months ago threatened to ignite a full-blown trade war. Trump recently claimed, "We're getting very close to a deal with China," though such optimism has proven fragile in the past. America's trade deficits with other countries have also narrowed. The gap with Canada is approaching a 5-year low, even amid stalled talks and hefty tariffs on autos, steel, and aluminum. the deficit with Germany is also the smallest in 5 years. But it's not all good news. Some key Asian trade partners, specifically Taiwan and Vietnam, are now reporting their largest surpluses ever with the U.S. But let's not sugarcoat things. The U.S. services sector, a critical pillar of economic stability, has started to feel the heat. Business activity stagnated in July, with employment numbers dipping for the 4th time in 5 months. Higher input prices, largely driven by tariff costs, have spiked to levels not seen since late 2022. Inflation, which had stayed subdued due to businesses offloading inventories stockpiled before tariffs took effect, now threatens to pick up, especially as prices for items like home furnishings start climbing. The big question: are we on the edge of stagflation, that dangerous mix of economic slowdown and rising prices? The answer remains uncertain. Some analysts argue that tame inflation in the services side might be keeping overall price rises manageable for now. Many business leaders voiced clear frustrations in recent surveys. One construction executive summed up a common sentiment: trade uncertainty is causing clients to rethink the feasibility of projects, leading to delays or outright cancellations. So what's your take? Are Trump's tariffs a bold, necessary move, forcing fairer and more balanced global commerce? Or are they sowing the seeds for higher costs and economic headaches down the road? What do you believe is the best way forward for the U.S. economy? Tougher trade policies or a renewed focus on open markets and international cooperation? Share your thoughts and join the debate below. This is one issue where every opinion truly matters. Impact of U.S. tariffs. Trade deficit hits 2-year low, services sector struggles. Imagine a world where trade wars and tariffs are the new norm and the global economy is feeling the pinch. But here's the shocking truth. The U.S. trade gap has just skidded to a 2-year low, and it's all thanks to the Trump administration's sweeping tariffs on imported goods. The trade deficit narrowed by 16.0% in June to $60.2 billion, with the trade gap with China shrinking to its lowest in over 21 years. But don't think this is all good news. The tariffs are exerting pressure on the service sector, which is showing signs of softening. And this is the part most people miss. The services sector accounts for roughly 2/3 of total U.S. economic activity, so any slowdown here could have far-reaching consequences. The Institute for Supply Management's Non-Manufacturing Purchasing Managers Index slipped to 50.1 last month, indicating a flatlining of business activity, with little change in orders and a further weakening in employment. But what does this mean for the average American? Well, for starters, it could lead to higher prices and reduced economic growth. And with the average overall U.S. tariff rate now at 18.3%, the highest since 1934, it's clear that the trade war is far from over. But here's where it gets controversial. Some argue that the tariffs are necessary to protect American industries, while others claim they're a recipe for disaster. So what do you think? Are the tariffs a necessary evil or a misguided policy that will ultimately harm the U.S. economy? Let us know in the comments. The China trade deficit, in particular, has narrowed by 70% over 5 months, with imports from China dropping to $18.9 billion. The lowest since 2009, and with the U.S. and China trade negotiators meeting last week, there's hope that a deal may be on the horizon. But until then, the trade war rages on, with the U.S. imposing a 30% tariff on most Chinese imports. The trade deficit with other countries, such as Canada and Germany, has also narrowed, but the deficit with Taiwan and Vietnam has surged to record highs. As the trade war continues to unfold, one thing is clear: the U.S. economy is in for a wild ride. And with the services sector showing signs of weakness, it's more important than ever to stay informed and up to date on the latest developments. So stay tuned for more updates, and let's keep the conversation going. But before we go, let's ask the question on everyone's mind. What's next for the U.S. economy? Will the tariffs lead to a recession? Or will the economy somehow manage to thrive despite the trade war? The answer, much like the trade war itself, remains uncertain. But one thing is clear: the U.S. trade gap may be at a 2-year low, but the real challenge is only just beginning.